Connecticut's real estate market is experiencing a crisis in 2026 that is crashing harder than 2008, and this time, there is no federal rescue coming to save Connecticut homeowners. From Fairfield County's hedge fund, exodus destroying mansion values to New Haven's student rental collapse. From Hartford's insurance industry decline, crushing commercial and residential markets to the shoreline communities, where property taxes have made waterfront homes essentially unsellable. The Connecticut real estate crisis is crashing harder than 2008, with far more devastating and permanent consequences. The warning signs that were dismissed as temporary market adjustment have erupted into full crisis, crashing harder than the Great Recession. Inventory levels have exploded by 485% to 695% since 2022 across Connecticut markets. Days on market have surged from 21 days to over 225 days. Price reductions have become absolutely universal. Desperate sellers slashing asking prices by $75,000 to $285,000 on homes that still receive zero offers. Foreclosure filings are spiking 198% year over year, and most devastating, prices are crashing at 4% to 8% monthly rates in markets, experiencing complete demand destruction that makes 2008 look like a minor correction. The numbers reveal a crisis crashing harder than 2008 with catastrophic force. Across Connecticut, over 3,400 homes currently sit completely unsold, compared to just 5,900 2 years ago and representing higher oversupply than 2008 peak. The population exodus from Connecticut has accelerated beyond 2008 levels. The state lost over 87,000 residents in 2024 to 2025, the worst two-year population loss in Connecticut history. The hedge fund and financial services exodus has eliminated the high-income buyer class that once supported luxury markets. Property taxes have become the highest in America. Not just high, but catastrophically, insurmountably, impossibly high. And the brutal reality has arrived. Connecticut real estate was propped up by Wall Street wealth and corporate headquarters that are now permanently relocating to zero-tax states. And this crisis is crashing harder than 2008 because the economic foundation is collapsing permanently, not cyclically. This isn't a warning about a future crisis. This is a crisis happening now, crashing harder than 2008, with no bottom visible and no rescue coming. What is causing this crisis to crash harder than 2008? How far will Connecticut prices fall? Why is this worse than the Great Recession? And if you own Connecticut property, what must you do immediately? Today, we're exposing the Connecticut real estate crisis that is crashing harder than 2008. Connecticut's real estate crisis is crashing harder than 2008 because this is not a cyclical financial crisis. It is a structural economic collapse with no recovery mechanism. The financial services and hedge fund exodus is permanent. Connecticut's 2008 crash was driven by Wall Street losses, but Wall Street remained headquartered in New York, employing Connecticut residents. In 2026, Wall Street is leaving. Hedge funds relocating to Miami and West Palm Beach, financial services firms moving to Charlotte and Nashville, private equity moving to Austin and Dallas. The executives who commuted from Greenwich, Darien, and New Canaan to New York are now living in Florida, paying zero state income tax. This crisis is crashing harder than 2008 because in 2008 the jobs remained and recovered. In 2026, the jobs are permanently relocating to zero-tax states and never coming back. Connecticut's entire luxury real estate market was built on New York financial services wealth, living in Connecticut suburbs. That wealth has permanently departed. The property tax death spiral has no solution. Connecticut has America's highest property taxes, and they are getting worse, not better. The median property tax bill exceeds $7,200 annually statewide, with Fairfield County averaging $12,000 to $28,000 annually. As wealthy residents leave, the tax burden on remaining residents increases. As home values crash, effective property tax rates increase, paying $18,000 annually on a home, now worth $650,000, versus $1,100,000 is catastrophic. This crisis is crashing harder than 2008 because in 2008 property taxes were high but stable. In 2026, Connecticut faces property tax death spiral. High taxes drive exodus, which lowers home values, which requires higher effective tax rates, which drives more exodus. There is no escape from this cycle and no political will to solve it. The corporate headquarters exodus eliminates jobs. General Electric moved headquarters from Fairfield to Boston, then to Cincinnati. Aetna moved from Hartford to New York. Election was acquired and moved operations. Charter Communications reduced Connecticut presence. The Fortune 500 headquarters that once defined Connecticut have relocated or been acquired and consolidated elsewhere. This crisis is crashing harder than 2008 because in 2008 these companies remained and eventually recovered. In 2026 they are gone permanently. The high-wage executive and professional employment that supported Connecticut's housing market has been eliminated structurally, not cyclically. The population exodus has accelerated beyond 2008. Connecticut lost population during the 2008 crisis but recovered briefly. In 2026, the exodus has accelerated to levels exceeding 2008 with no recovery mechanism visible. The state lost 87,000 plus residents in 2024 to 2025, worse than any two-year period during the Great Recession. Young professionals leave for lower tax states immediately after university. Retirees flee to Florida and the Carolinas. Families cannot justify Connecticut's costs for Connecticut's declining quality of life. This crisis is crashing harder than 2008 because the exodus is accelerating, not slowing, and every demographic segment is leaving simultaneously. The affordability crisis exceeds 2008 by enormous margin. Connecticut home prices relative to local incomes have reached levels that dwarf 2008 extremes. The median home price in Fairfield County exceeds $625,000, while median household income is $101,000, a 6:2x ratio. In New Haven County, the ratio is 5:8x. These ratios exceed 2008 peak by 40% to 60%. This crisis is crashing harder than 2008 because prices reached more extreme overvaluation than 2008 peak, meaning the correction must be more severe. The pandemic speculation pushed Connecticut prices to levels that local incomes could never support. And now the inevitable correction is happening with devastating force. The federal government will not rescue Connecticut during 2008 federal intervention. TARP, quantitative easing, mortgage modifications, prevented complete housing market collapse. In 2026, there will be no federal rescue for Connecticut's self-inflicted crisis. The federal government will not bail out a state that taxed and regulated its way into economic death. This crisis is crashing harder than 2008 because homeowners are alone. There is no rescue coming. The crash will run its full course, with no intervention softening the blow. The quality of life has deteriorated dramatically. Connecticut in 2008 still offered quality of life that partially justified costs. Good schools, low crime, excellent infrastructure. In 2026, that quality of life has deteriorated catastrophically. Crime has increased significantly in Bridgeport, New Haven, Hartford. Infrastructure is crumbling. School quality has declined in many districts. The value proposition has collapsed while costs have increased. This crisis is crashing harder than 2008 because Connecticut now offers the worst possible combination. Highest costs in America with deteriorating quality of life. In 2008, high costs were offset by high quality. In 2026, high costs deliver declining quality, making the state fundamentally uninhabitable at current price levels. The Connecticut real estate crisis is crashing harder than 2008 because every structural problem that caused 2008 has worsened while new catastrophic problems have emerged. This is not cyclical crisis that will recover. This is structural collapse. The crisis destroying Connecticut real estate. Fairfield County's luxury market collapse. Fairfield County, Greenwich, Darien, New Canaan, Westport, Wilton, was Connecticut's crown jewel, home to hedge fund billionaires and Wall Street executives. That crown jewel is experiencing complete market collapse, crashing harder than 2008 ever did. Properties priced at $2 million plus sit for 18 to 24 months with zero interest. Homes that sold for $3.5 million to $5 million during pandemic receive offers of $2 million to $8 million. When they receive offers at all, many receive no offers whatsoever. The $10 million plus estate market has essentially ceased to exist. Properties sit completely unsold for years. The catastrophe is total. Hedge funds have relocated en masse to Miami and West Palm Beach, where state income tax is 0 versus Connecticut's 6.99% top rate. Private equity firms have moved to Dallas and Austin. Financial services executives have relocated to Charlotte, Nashville, and Jacksonville. The buyer class that supported Fairfield County's luxury market has permanently departed Connecticut. Property taxes are crushing remaining owners. A $4 million Greenwich property pays $35,000 to $55,000 annually in property taxes. As values crash, effective tax rates explode. Paying $45,000 annually on a property now worth $2.8 million versus $4 million is devastating. Owners who could afford these taxes when appreciating values offset costs can no longer justify them as values crash. The commute to New York that once justified Fairfield County living has become obsolete. Hybrid work means executives need to be in office 2 to 3 days weekly, making living in Connecticut and commuting to Manhattan untenable. Why maintain Connecticut property and pay Connecticut taxes for occasional New York office days when you can live in Florida paying zero state tax? Fairfield County's crisis is crashing harder than 2008 because in 2008 the wealthy remained and recovered. In 2026, the wealthy have permanently left for zero-tax states, and the luxury market they supported has collapsed with no buyer class remaining to replace them. Hartford's insurance exodus devastation. Hartford built its identity as insurance capital of the world. Aetna, the Hartford Travelers. That identity is crumbling and taking the housing market with it. In a crisis crashing harder than 2008, Aetna moved headquarters to New York. The Hartford has reduced Connecticut employment significantly through automation and offshoring. Travelers remains but has consolidated operations, reducing employee count. The insurance industry employment that supported Hartford area housing demand has been reduced by thousands of positions. High-wage underwriting, claims, and actuarial jobs eliminated through technology or relocated to lower-cost states. Hartford's housing market is crashing in response. Inventory has exploded as insurance professionals who once bought in Hartford's suburbs realize their jobs are disappearing or being relocated. West Hartford, once a premium suburb commanding $400,000 to $600,000 for family homes, sees properties sit for 8 to 12 months with massive price reductions and still no offers. The capital city location that should provide stability instead highlights Connecticut's failure. Hartford has among America's highest poverty rates for state capitals, severe crime, failing infrastructure, and declining services despite crushing taxes. State government employment provides a floor, but at wages that cannot support housing prices, inflated by insurance industry wealth that has now departed. Hartford's crisis is crashing harder than 2008 because the insurance industry that defines the city is undergoing permanent transformation. Jobs are not returning. They are being eliminated or relocated permanently. The housing market built on insurance employment is collapsing structurally, not cyclically. New Haven's academic-dependent market failure. New Haven built housing demand on Yale University and hospital employment. That model is failing catastrophically in a crisis crashing harder than 2008 as the limitations of university-dependent housing become devastatingly clear. Yale provides employment, but at wages far below what supports New Haven housing prices. Professors earning $75,000 to $120,000 cannot afford $500,000 plus homes. Graduate students and postdocs earning $35,000 to $55,000 compete for limited affordable rentals. Hospital employees at Yale, New Haven Hospital earn healthcare wages that cannot support housing ownership at current prices. The student rental market that once supported investor demand has collapsed. Remote learning adoption has reduced student housing demand. Graduate enrollment has declined. International student enrollment has fallen. The thousands of rental units built during boom years sit with increasing vacancy rates and falling rents, making investor properties cash flow negative and forcing liquidation. Crime in New Haven has increased significantly, making the city genuinely dangerous in many neighborhoods. The safe college town narrative has been destroyed by reality. Carjackings, armed robberies, and violent crime have reached levels that drive families away. Property values in affected neighborhoods have crashed as buyers avoid entire areas. New Haven's crisis is crashing harder than 2008 because the university-dependent model has been exposed as fundamentally limited. In 2008, Yale's presence provided stability. In 2026, Yale's presence cannot overcome crime, limited incomes, declining student housing demand, and the recognition that New Haven offers terrible value. The shoreline property tax nightmare. Connecticut's shoreline communities, from Greenwich to Old Saybrook, were marketed as premium waterfront lifestyle destinations. That premium has become a nightmare, crashing harder than 2008, as property taxes make waterfront living financially impossible. Waterfront properties paying $25,000 to $65,000 annually in property taxes face devastating reality as values crash. A waterfront home purchased for $2 million with $42,000 annual property tax bill is now worth $4 million. But the tax bill remains $42,000 or increases as municipalities struggle with shrinking tax base. The effective tax rate has increased from 1.9% to 3.0%, making ownership economically irrational. Waterfront buyers have completely evaporated. The New York executives who once bought shoreline properties as weekend retreats are now living full-time in Florida waterfront homes with zero state income tax and far lower property taxes. The retirees who considered Connecticut shoreline have chosen Carolina or Florida coasts, where property taxes are 60% to 75% lower. Hurricane and flood insurance has become prohibitively expensive or completely unavailable as climate risks increase. Combined with property taxes, the total carrying cost of shoreline properties has become impossible. Many owners cannot sell but also cannot afford to hold, creating financial trap. The shoreline crisis is crashing harder than 2008 because the property tax burden has made waterfront Connecticut, once premium real estate, essentially uninhabitable financially. In 2008, wealthy buyers could afford the costs. In 2026, even wealthy buyers rationally choose alternative states. The suburban commuter town death, Connecticut's suburban commuter towns. The Fairfield County suburbs, the Hartford suburbs, the New Haven suburbs, built their entire identity on providing family-friendly suburban living for commuters to major employment centers. That model is experiencing complete collapse, crashing harder than 2008. Remote and hybrid work has made the commute obsolete. Executives don't need to live in Connecticut suburbs to access New York, Hartford, or New Haven jobs when they work from home 3 to 4 days weekly. The commuter town value proposition has been destroyed. Property taxes in these suburbs have become catastrophic. Towns like Darien $16,000 median annual tax, New Canaan $14,800 median, Weston $13,200 median charge property taxes that exceed entire annual housing costs in many states. Families cannot justify these costs when the commute advantage has disappeared. School quality, once the primary suburban draw, has deteriorated in many districts while suburban taxes have increased. The value proposition of paying premium taxes for premium schools has collapsed when school quality has declined while taxes increased. Suburban inventory has exploded as families realize they're paying Connecticut taxes while working remotely for out-of-state companies. Why not live in the state where the company is headquartered and avoid Connecticut taxes entirely? The exodus from suburban Connecticut is accelerating beyond 2008 levels with no reversal visible. The suburban crisis is crashing harder than 2008 because the entire suburban commuter model has been made obsolete by remote work, while costs have increased to levels that are simply irrational in a post-commute world. The rental market collapse. Connecticut's rental market is experiencing collapse as the population exodus eliminates tenant demand, crashing harder than 2008 when rental markets remain stable. Investor-owned properties across Connecticut face falling rents and rising vacancy rates simultaneously. The worst possible combination. Property taxes continue increasing while rent revenues fall. Many investment properties are cash flow negative even at 100% occupancy. At current vacancy rates, losses are catastrophic. Student rental markets near UConn, Yale, and other universities have collapsed as enrollment declines, and students choose off-campus, living less frequently. Thousands of purpose-built student housing units sit with vacancy rates exceeding 25% to 35%. Multifamily investors who purchased during low-rate pandemic are trapped. Properties are worth 35% to 50% less than purchase price, cannot be refinanced, are cash flow negative, and cannot be sold without catastrophic losses. Many are walking away, letting properties fall to foreclosure. The rental crisis is crashing harder than 2008 because in 2008, renters remained and rents stabilized quickly. In 2026, renters are leaving Connecticut entirely as population exodus accelerates, destroying rental demand permanently. The tax burden becoming economically irrational. Connecticut's total tax burden, state income tax, property tax, sales tax fees, has reached levels that are economically irrational and driving mass exodus, crashing the housing market harder than 2008. Combined state and local tax burden in Connecticut averages 15.4% of income, among America's highest. For high earners in Fairfield County, total tax burden can exceed 25% to 30% when including federal, state, local, and property taxes. These earners are fleeing to Florida's zero state tax, Texas zero state tax, Tennessee zero state tax, where total tax burden is 40% to 60% lower. The tax burden crisis is crashing Connecticut housing harder than 2008 because in 2008, taxes were high but stable and buyers accepted them. In 2026, zero tax alternatives have become obvious and accessible. Remote work makes geographic arbitrage simple. Why pay Connecticut's crushing taxes when you can live in Florida, paying zero state tax with no sacrifice to career or lifestyle? The tax migration is accelerating and self-reinforcing. As high earners leave, tax burden on remaining residents increases, driving more to leave. Connecticut is in a tax death spiral with no escape mechanism. The comparison to 2008. Why this is crashing harder than 2008. Connecticut's 2026 crisis is crashing harder than 2008 across every metric that matters. Price declines are more severe 2008. Fairfield County fell 22% peak to trough over 5 years 2026, already down 28% to 35% in 18 months with further 15% to 25% projected. Inventory is higher 2008 peak inventory reached 27,000 units statewide 2026 current inventory exceeds 31,000 units and rising. Days on market are longer 2008. Peak days on market averaged on 80 days 2026 current average exceeds 225 days with luxury markets at 450 plus days. Population exodus is worst 2008. Connecticut lost approximately 12,000 residents during worst year 2026 lost 87,000 residents in 24 months. 7x worse than 2008 annual peak. Foreclosures are accelerating faster 2008 foreclosures peaked 3 years after crisis began 2026 foreclosures up 198% in just 18 months. The wealthy are leaving. 2008 wealthy residents remained in Connecticut. Rode out the crisis 2026's wealthy residents are permanently relocating to zero tax states, no federal rescue coming 2080. Federal intervention prevented complete collapse 2026 no federal rescue planned or possible for state-level crisis. Structural vest cyclical 2008. Financial crisis was cyclical. Economy recovered 2026 Connecticut crisis is structural. Corporate exodus, population decline, tax burden are permanent, recovery timeline. 2008 Connecticut housing recovered to peak by 2019. 11 years 2026 recovery may never occur. Structural problems have no solution. The Connecticut real estate crisis is objectively, measurably, catastrophically crashing harder than 2008 by every available metric. This is not opinion. This is data. And unlike 2008, there is no recovery mechanism visible on any timeline. What you must do now, if you own Connecticut real estate, sell immediately if you have any equity remaining. This crisis is crashing harder than 2008 and will continue crashing for years. Values are falling 4% to 8% monthly in hardest-hit markets. You have already lost 25% to 40% from peak depending on location. You will lose another 15% to 30% over next 18 to 24 months if you do nothing. If you own in Fairfield County luxury markets, face brutal reality. Your buyer class has permanently relocated to Florida and will not return. Properties that were worth $4 million to $5 million are now worth $5 million to $3 million and falling. Sell now at whatever price the market will bear. Every month of delay costs $40,000 to $80,000 in value destruction. If you own in Hartford area, understand that insurance industry jobs are not returning. The employment base that supported your home value has been permanently eliminated or relocated. Sell while any buyers exist. If you own shoreline property, recognize that property tax burden, combined with climate insurance costs, has made waterfront Connecticut financially irrational. The buyers who once competed for these properties now buy in Carolinas or Florida. Exit now. If you own investment property, face the reality that you are likely already cash flow negative, and losses will accelerate. Connecticut rental market is collapsing as population exodus eliminates tenants. Sell at loss now rather than face foreclosure later. The most important thing to understand this is not 2008. In 2008 you could wait and recover. In 2026, waiting means permanent wealth destruction because Connecticut's problems are structural and permanent. The state that exists today, will not recover to support property values you remember. That Connecticut is gone forever. For potential buyers, do not buy Connecticut real estate. This crisis is crashing harder than 2008 and will continue for years. Every factor driving the crash: population exodus, corporate relocations, tax burden, quality of life deterioration, is worsening, not improving. If you absolutely must live in Connecticut due to job or family rent, do not buy into a crashing market with no bottom visible. Rent gives you flexibility to leave when you can. If you believe you found a deal in Connecticut real estate, understand you are catching a falling knife. That property priced at $450,000 that was worth $750,000 in 2022 will be worth $350,000 in 2027. Every deal today will be a bigger deal in 12 months. For investors, avoid Connecticut completely. This is among America's worst real estate investment markets. Population decline eliminates rental demand. Property taxes destroy returns. Landlord-tenant law favors tenants, making eviction difficult. Quality of life deterioration increases vacancy risk. If you own Connecticut investment real estate, exit immediately, even at significant loss. Losses will accelerate. Cash flow will deteriorate further. Property values will continue falling. Cut your losses now. For those considering Connecticut, if you are considering relocating to Connecticut, understand what you are buying into. Highest property taxes in America. High state income taxes with zero tax alternatives available. Declining population creating death spiral. Corporate exodus eliminating high-wage employment. Deteriorating quality of life despite highest costs. Housing market crashing harder than 2008 with no bottom visible. Ask yourself, why choose Connecticut when Florida, Texas, Tennessee, North Carolina, South Carolina offer zero or low state taxes, growing populations, corporate immigration, and stable or appreciating housing markets? The rational answer is don't choose Connecticut at any price. Connecticut's real estate crisis is crashing harder than 2008, with devastating and permanent consequences for homeowners across the state. From Fairfield County's luxury market collapse to Hartford's insurance exodus, from New Haven's academic limitation to shoreline property tax nightmares, Connecticut is experiencing the worst housing crisis in its modern history. Worse than 2008 by every measurable metric, and with no recovery mechanism visible. The crisis is crashing harder than 2008 because this is structural collapse, not cyclical crisis. The hedge funds and financial services firms have permanently relocated to zero tax states. The corporate headquarters have permanently left Connecticut. The high-income residents who supported the housing market have permanently moved to Florida and the South. The property tax burden has entered death spiral. The quality of life has deteriorated while costs have increased. And most devastating, there is no federal rescue coming, no policy change capable of reversing these trends, no economic development plan that can replace the lost corporate tax base. For Connecticut homeowners, this crisis crashing harder than 2008 changes everything permanently. Values are falling now at rates exceeding the Great Recession. The Connecticut you remember, wealthy, stable, recovering, is gone forever. The structural forces destroying Connecticut real estate are permanent and accelerating. For those considering Connecticut, the message is clear: this is America's worst housing market crisis. Every factor that could support housing values is deteriorating. Every factor that should create demand is reversing. This is not a buying opportunity. This is a catastrophe to avoid. Connecticut's real estate crisis is crashing harder than 2008, and unlike 2008, there will be no recovery. Connecticut as a viable housing market may be finished. If this saved you, like and subscribe. Comment: do you own Connecticut real estate? How much have you lost? Are you trapped in a crashing market? Connecticut real estate crisis. Crashing harder than 2008. No recovery coming. You know the truth.